Hello and welcome. The markets have been volatile, mid and small caps have come under pressure, and valuations divide opinion. To help us make sense of it all and to understand what's really driving the outlook for equities, we're joined by Sachin Trivedi. He's fund manager at UTI Mutual Fund. Sachin manages some of UTI's key strategies, including the Balanced Advantage Fund, Children's Funds, and Infrastructure Funds, as well as the Transportation and Logistic Fund. Sachin, thank you for joining us.
Thank you.
Let's begin this conversation with the volatile markets, especially in the mid and small cap space, where returns have turned negative over the past year. Despite the strong domestic inflows, equities, they haven't really moved. So, what do you think is holding them back right now?
Okay, so I think I'll give you some background about the earnings because they are the most important factors as far as markets are concerned. So maybe between FY20 to FY24, at the market level, we had maybe if just look at the Nifty, we had 19% CAGR earnings growth. Post that, I think last year was a year of consolidation, and maybe if you look at the Bloomberg consensus, this year also expected to be 8-9% kind of a growth as far as earnings are concerned. So I think this is the period from 20 to 24 has been fantastic period. But if I were to say people, the point that you raised about domestic flows, right? I think flows are continuing to sustain because maybe to some extent people are also looking at the past returns before allocating their money, and good chunk of this money is also coming from systematic investment plans of mutual funds, right? Um, Having said that, because there is a large chunk of flows, but there are pockets of investors who are maybe it's investors maybe in form of foreign flows or in form of domestic promoters. I think they are sensing maybe somewhere the valuations are expensive and they are actually profiteering out of it. So maybe if there is a good demand, there is a simultaneously a supply as well, which is incurring. Net, I will say because the earnings have consolidated, have not performed as great as what we have done between 20 to 24. That's the reason why I think there is some bit of consolidation we have seen in the market. I think this is the period, if you look at the top line growth for the companies have already slowed down for last 1.5 to 2 years. It is just that the profit margins have expanded for the companies. And now both are converging, both the top line and the profit margins, profitability have converged, which is where we've got this subdued kind of a performance. And till the time we improve on that, I don't see market giving you a great kind of a return. And mid cap, small caps are also equally facing the same grind.
Sachin, and has the recent correction made the valuation meaningfully better, or do you still find market expensive in some pockets?
So, of course, let's say if you look at the pockets of, we have to look at from both the PE and the price to book perspective. But when you look at the large cap are still slightly expensive from a longer term perspective, but they have actually not in a very expensive zone, I will call it. And still the earning growth momentum as the Bloomberg consensus or whichever parameter you show, they are still high single digit kind of a number. When you come to the mid cap, of course, the performance is slightly better, but small cap performance, as far as earnings are concerned, has substantially moderated. But here, the valuation, if you look at from the price to book perspective, the valuations in mid cap and large cap at the index level itself is somewhere between 30 to 50% more expensive than their historic averages. So in past, it was good to give maybe some bit of a higher valuation compared to large cap, but when the earnings have moderated, maybe sub part of the large cap, I don't see any sense for participants to give higher multiple or to justify that. So I think eventually those will align in terms of earnings performance.
Right now, let's talk a bit about your approach. How would you describe your overall investing style, and what are the key factors that drive your stock selection across market cycles?
Sure. So if I were to talk about my style, I'll call it maybe in a blend approach where I am looking at stocks more from a sectoral, the sectors which have some bit of a earnings tailwind or a valuation support. Of course, there is a bit of a weight given as far as sectors are concerned, and within that, I try to look for the stocks which can give me the best of the outcomes. Of course, but when I talk about the approach in terms of selecting the stocks, of course, when you look at the portfolio, final portfolio, there is bit of a quality bias as far as fund is concerned. So, be it in terms of the return ratios or be it in terms of the cash flows, you will find that it sits at somewhere higher bucket as far as the fund is concerned. But having said that, it's not that we're just looking for high growth or a very high quality kind of stocks. We are also open as far as fund is concerned to look into the companies which have some bit of a value and some bit of a growth, which is where we are seeing that over a period of 24 to 36 months, they will achieve their best of the outcomes. Also, the turnaround stories, we are again open there. So in some of the cyclical stocks where we find that the companies are at a cyclical bottom, but at the because the profitability is substantially impacted, their valuation appears expensive. We look through that and eventually focus on what will be the eventual 24 to 36-month outcome, and basis that we are also open to investing in stocks. And similarly, if there are any turnarounds on the management side. So I think it's a mixed approach, which is where I call it, it's a blend approach. But when you net look at the portfolio statistics over a long period of time, you'll find some bit of a quality bias as far as fund is concerned.
Now, Sachin, you handle two very different strategies. One is the transport logistic on the one side and the balance advantage on the other side. How do you adapt the investing styles to each, and what factors remain constant when selecting stock across the market cycles in both these different categories?
So I think the if you look at the approach again, be it the balance advantage or be it the transportation, maybe the approach would remain more or less the same. You will find a slight bit of a large cap bias in both the cases because, like I said, quality is an approach where we are looking for the probably the market leader within those companies and maybe the growth bias. That's what you will find it. But of course, being part of the transportation and logistics fund, here the approach is because we have choice of only investing in either the auto ancillaries or maybe the logistics space. So of course, you have to look for the companies which are consistently or companies which are likely to gain market share over a period of time. So of course, that auto being a cyclical sector to an extent, so you have to be extra cautious about which are the companies basis the product launch cycle, which are likely to gain market share, and which companies have the product. And incidentally, these companies will also have the better pricing power as far as a sector is concerned. So we keep looking for those companies where, as far as auto OEMs are concerned, where there is a probability of market share gain. And within auto ancillaries, again, it's the companies which are not just monoline companies, but also we look for a slightly diversified portfolio as far as the product mix is concerned, geographies are concerned. And of course, again, here in auto ancillaries, what is more important, if there is any regulatory support which is coming to, say, for example, safety features or a feature change which is coming in the like what is now is the ADAS is more in line. So I think those are the pockets of opportunity that we look for. Of course, in this, what is more important is integrity of the management as far as auto ancillaries are concerned, the management which are driven for growth. So that's, I think, the overall approach we keep it rather than falling in the value trap where just the valuations are too cheap, just there is high dividend yield but no growth. I think we look to avoid those pockets.
Coming to the UTI Balanced Advantage Fund, it has held up very well even when the markets have been largely flat in the past 1 year or so. What are the key calls or the allocation shifts that has helped you deliver the better returns? Secondly, how do you determine the fund's equity and debt split? Is it primarily model driven or do you use discretion depending on the market condition?
Sure. Okay. Sure. So first, look at the how do we address the allocation, and since launch, our promise to the investors is that what we will do in this fund is that we will follow a disciplined approach of valuation, which is whenever the valuations are expensive, we will cut back our exposure to the net equity, and whenever they are cheap, we will increase our allocation. So the question which you have is that how do we decide? Again, there is a proprietary model we have internally. Basically, this proprietary model looks at four factors. Three of them, incidentally, are market linked, which is the price to equity, 1 year forward price to equity, price to book, dividend yield, and the fourth factor, which is looking at the interplay between equity yield and the bond yield. So, which is basically looking at which piece is more important. Post that, I think there is a detailed statistical analysis run, but from a simplicity perspective, like I said, expensive valuation, we cut back our value net equity allocation, and when it is cheap, we increase it. So in last 1 year, for example, September, so we had three changes. So September of 24, when the valuations were very expensive for the market, we were sitting at 45% allocation. Somewhere in December, we have increased it to 54% or 55%. And then in February, in the mix of the big noise which was going around, all the tax related, or maybe the US tax related issues, I think we've taken our allocation towards 65%, and since then we have been consistent with that. So that's how the approach is. Now these signals to us from the model comes every week, but like I said, we've just taken three changes, so we try to avoid multiple noises, and we just, if the difference between the model indication and the fund is more larger than enough, more than 7%, we undertake that change. So yeah, that's the allocation perspective. As far as maybe which sectors and which stocks have done better for us, I think maybe stock selection as well as maybe overweight allocation towards auto has worked well for us. Maybe the services related stock as well as sector allocation has worked very well for us, and maybe the underweight on FMCG and oil and gas has worked well for as far as the sector, as far as stock selections is a sector and stock selection is concerned. Maybe where we've got wrong is bit of overweight on IT, bit of stock selection on financial services. I think those are the two or three areas where we've got wrong, but net, like we said, maybe the outcome was satisfactory for us.
Right. Talking about the UTI Transportation and Logistics Fund, which has delivered strong performance even amid sectoral volatility. Can you please elaborate what, in your view, has driven this resilience, and how do you go about identifying opportunities within such a diverse and cyclical space?
So yeah, I think like we've discussed, this is a cyclical space,
Yeah.
and again, from my perspective, I think the winners, when you look at the cycle, long enough cycle, both in domestic as well as outside India, what is most important as far as OEMs are concerned is basically what is the product launch cycle for each of the OEM, and remember that each product takes 3 to 4 years for OEM to from initial stage to the final stage. It takes 3 to 4 years for OEM to launch products. So it's very important to keep an eye on which products are likely to get launched, and which is where a success of each of the product is very important, because with that, what follows is your pricing power on each of the product, and your pricing power as far as your operating leverage are also again linked to that. Uh, so the entire ecosystem thrives as far as companies are concerned on that, and maybe some of the companies are very aggressive on planning, and we have a couple of example in domestic market as well. Again, what is important is the trend as far as what is the trend which is going in the market. So for very sure, in Indian market, what we have seen is that the base level car or the small cars have not done that well as far as past is concerned, and gradually shifting more towards SUV or SUV like vehicles. So again, that those kind of trends are important, and the product launches within that is important. So that's actually the important metrics, and within that, I think the capital allocation decision of the management is again important. Now, as far as auto ancillaries are concerned, like we've discussed, is what is more important is that which companies align to which of the successful model rather than just the companies, right? So successful model alignment with that is important. Investment into various joint ventures, because I think what's happening in India is still we are doing a lot of indigenization of the products. That's how the OEMs are also driving more of the margin expansion. But more importantly, it's in value the business opportunity for some of the auto ancillaries. So, which companies can successfully drive these JVs, extract value for them? What is the aggression within the management from them? And eventually, in light of that, especially as far as auto ancillaries are concerned, very important is that what is the return ratio profile of each of the companies? Because many of them get stuck into expand growth mode, but then their return ratio profile is very low, and eventually they come out with multiple rounds of dilution. So I think combination of this is what we keep in mind while selecting the stocks as far as transportation and logistics fund is concerned.
Now, if you look at the auto sector, EVs have been on the spotlight for the past few years now. Do you think the hype is justified or have the expectations run bit ahead of the reality?
Yeah, yes, actually, initial phase, maybe 3, 4 year back, I think there was a bit of an overhype, certainly, and that's where we have seen a lot of conventional companies where the reported numbers were good. Companies had healthy balance sheet, but still there, if you look at the European companies or even the US companies, there was a significant derating as far as their valuations are concerned. But now gradually with this hype coming back. And I think this hype was there rightfully because there were some successful models which were doing really well. There was acceptability of those successful models. But at the same time, there was some bit of intervention from the government side as well by putting more stringent norms, by giving a good amount of incentive for the consumers to purchase. And at the same time, the cost of material, especially the battery prices, were also coming down at the rapid pace. So there was this expectation that the adoption rate as far as EV is concerned will be very high. But I think gradually all of these hype have come gradually to more practical level. And here we've seen that governments have gradually cut back on the incentive. There is also realization from the government side there is no point pushing companies too much as far as regulatory norms are concerned. And at the same time, consumers are, after the initial hype or initial overestimation, consumers are also now struggling to figure out what is the infrastructure available, what is the resale value of these vehicles, how long I can drive it. So all of this is now gradually settling. I still believe that even after all this hype or gradual settlement, I think eventually the future lies in EVs, which is where most of these companies, if you see the incremental capital allocation towards R&D, it's more happening towards EV side. So I think it will happen, but it will happen more at a gradual space, and which is where I think more practical approach is appearing as far as global arena of EV space is concerned. Of course, within that, China is doing extremely well. Maybe certain pockets of Europe, some companies are doing well. But I think in India also, we have seen some success as far as two-wheeler is concerned, where the adoption rate is close to 7 to 8%. But PV, because the cost economics is not in full in place, so we're still struggling with 2, 3% kind of a penetration.
Right, but valuations in EV focused companies, they've gone through the roof and often without much of a track record right now. So, how do you assess such businesses objectively without getting carried away by the story, but also, without dismissing them too early?
Sure. So if effectively, where the investors are too much focused about is what is the eventual penetration level will happen in each of these areas, maybe 10 year and 15 year down the line, and which are the successful companies. So even when we look at Indian companies itself, like we've discussed overhype, within two-wheeler space, there were, if I'm not wrong, there were more around 50 odd players in the two-wheelers, but gradually and some of these leaders maybe 3 years back no longer the leaders because I think gradually what investors have started realizing is that which of the companies have ability to roll out a successful more stable products. and which is where I think gradually the cases are settling as far as some of the companies which are now started to getting recognition from the investor on more stable kind of a method. Same stories we have seen a good bit of investments which have happened in the four-wheeler space, where in some of the existing companies, the carved out subsidiaries were created and maybe the investments have happened. But eventually, like I said, business case will settle with the companies which have successful track record as far as products are concerned. And basis that, maybe you can decide what is the fixed cost of each of these models and how the cost economics will work over a period of time. But I fully agree at this point in time, it is a difficult task. Of course, you will have to spread out your investment over a couple of companies and maybe figure out which is the best company work for you, and eventually position size the position accordingly, which is the successful company.
Given the gradual shift towards EV, should investors still look at the companies where internal combustion engines dominate the portfolio? What are some indications that one shouldn't look at the companies big on non-EVs?
So, yeah, you're right. Maybe there are expectation that in two-wheeler by 2030 or 30% penetration will happen, and maybe a good chunk of penetration will happen as far as four-wheelers are concerned. So here I'll stick more to the domestic part of assessment, and my sense is that what we have figured out is that because the pace of acceptance is gradual as far as EV is concerned, it has given good breathing space for some of the existing conventional ICE-based companies to introduce products. Because remember, even in the EV arena, a good chunk of costing lies with, because these guys have a good supply chain. All these existing guys have a good supply chain. So that's what is giving them some bit of a leverage over the new age companies. Remember, from existing company perspective, they will have to necessarily invest, and we are seeing signs that the companies are investing because if they don't invest, they will eventually lose market share and the business case will be out. So we see all of them investing. Of course, some of them will be more successful, some of them will be less successful. Um, but having said that, because of the supply chain benefits which some of these guys have, they are necessarily investing, and some of them have successful track record of addressing the consumer needs and demand as well. So my sense is that it makes sense for us to not dismiss some of these OEMs, because they can support the new initiative with the existing cash pool which they have. So that's where I think it makes perfect sense for us to keep existing OEMs under the consideration set.
And beyond EVs, what other trends within auto space look interesting to you right now? Where do you see better risk reward?
So yeah, I think two or three trends which are clearly emerged over a period of time, and I think these are trends which will continue to sustain, because that's how the OEMs are also investing, which is clearly there is investment which is happening towards SUV. So more and more product launches are going to happen. Now, this is important because we may be just fixated on what is going to be the volume growth, but SUV or more premiumized product portfolio gives you more high or give higher realization and maybe better profitability as well. So I think that's one important trend, and maybe a successful player in that category is worth looking at it. Similarly, as far as two-wheelers are concerned, clearly there is a shift away from, let's say, 100 or 110 cc to maybe 125 cc or 350 cc. So higher range is where the consumers are preferring to go. And of course, EVs continue to sustain because again, in two-wheelers, the EV penetration is better. So I think clearly these are two or three trends. But as far as auto ancillaries are concerned, uh, again, there is good chunk of regulatory support is coming as far as auto ancillaries are concerned, which is where you will see safety related norms which are coming into the place, or clearly there is now talks about ABS getting implemented as far as two-wheelers are concerned, or the CAFE 3 norms actually coming into the play for most of the companies. Even same is true for as far as tractors are concerned. So multiple of these changes which are coming, and the companies rightfully placed in each of these areas with technological edge should definitely do better. So I think these are a couple of trends which are in place.
Input cost and the pricing power can swing sharply in this sector. What indicators do you track to gauge which companies can sustain margins across cycles?
So, look, we have seen in past, I think even a good number of companies. So, especially, I think post 2017, right, when we have changed, we have seen changes in the sector from BS3 to, let's say, BS 6 stage. Then multiple rounds of changes have happened. We have seen the leaders as far as all of these spaces are concerned, especially in the four-wheeler. Most of them have lost good chunk of gross profit margin, and then there is this operating leverage which also keeps hurting them. So it's very difficult for some of these companies when the operating leverage is not with them. They struggle, be it the two-wheelers, be it the basically your four-wheeler as well as. So again, go back to the same point. The companies which have good product cycle or likely to have good product cycle, at least give them good pricing power as far as consumers are concerned. Because remember, if you don't have good product, one or two good products in your portfolio, then you have to necessarily offer higher discounts to your consumers. Operating deleverage also comes and hit you. So not only your gross profit margin, but the EBITDA margin also significantly get hurt. So that's actually the problem with the auto OEM, because it's cyclical. The product cycle and market shares are very, very important. Otherwise, at least the past demonstration of the cycle we have seen, there was a struggle as far as most of the companies are concerned. So that's as far as OEM is concerned. But when we talk about auto ancillaries generally run a pass-through model. So commodity cost and most of the cost for them are pass-through items. Only thing what benefits or hurts them is the operating leverage or deleverage through the cycle. So I think that's the gamut within which you have to keep playing around.
Right. So, like you mentioned, autos are inherently cyclical and timing that cycle is tricky. So, how do you approach that in your fund? And for an average investor, what is a sensible way to deal with the sector's ups and downs?
So for us, I think because maybe close to 90% of the money is invested in auto, so it's tough. So in tough times, we look for the leader, we look for the companies with healthy balance sheet, we look for the companies which have basically a good track record of the past. And the driven management, basically the management which are consistently focused on good cash flows, good growth. All of these parameters is what we are necessary to look at. But again, market share is very important, because low market share companies or the challenger in the space. So typically what we have seen in this category, especially OEMs are concerned, the top one or two players in each of the category make most of the money, and the challenger actually struggles. So when the times are good, maybe you can make good delta as far as these challenges are concerned. But when the times are or tide is turning, I think it's better to stay invested in with the top one or two players, and maybe try to play down maybe the challengers in the category, because that's where you get the maximum shock as far as profitability is concerned. So I think that's one thing which we need to keep in mind as far as the space is concerned. And from investor perspective, it is very important. If I were to talk about the average investor, the thumb rule which I always keep in mind is that peak of the margin, peak of the growth stories, I think it's better time for investors to exit. And when there is a maximum pessimism in the market, is maybe the time for the investors to enter as far as sectors is concerned, especially auto sector is concerned.
Finally, what valuation framework do you follow in the auto space? Do you use the different lenses for different segments? And how do you spot contrarian opportunities when market sentiment is one sided?
Yeah, I think as far as OEM is concerned, we use the plain vanilla, basically PE, PB. But within the PE, I think it's the core PE is very important because some of these companies are sitting on huge chunk of cash, and there is no point giving multiple to the cash or the other income of the company. So I think that's very important, which is where the EV EBITDA also kicks in for some of these companies. So that's where traditional approach as far as these companies are concerned. And of course, like let's say company which is gaining market share over a period of time is and maybe having a healthy return ratios and a good capital allocation policy is where we give tend to give slightly more higher multiple compared to the rest of the place, and clearly avoid valuation trap where maybe the multiples are cheap, return ratios are high, but there is no growth track record in past. So I think that's category avoid, but better category to be in is the growth category. As far as auto ancillaries are concerned, again, very important for us to give maybe from a differentiation perspective, a monoline business, even if it is suitably placed in the cycle, we tend not to give a over multiple for them or very high multiple for them because eventually there is a limited time available for these companies to actually address. So what we try to give a higher multiple to the companies is where they are diversified, not just in terms of product, but also in terms of a geography. Now, so, and maybe the companies are more aggressive or favorably placed in terms of chasing the growth opportunities, tying newer and newer JVs because developing technology on own is very limited as far as Indian space is concerned. But even this route is fine because it's also a route which is probably promoted by the OEMs. So I think these are some of the factors that we look at the auto ancillaries are concerned. So yeah, I think that's the gamut in within which we try to do it. Of course, when the going is good as far as sector is concerned, very difficult to find an contrarian opportunity. But what we have identified is that over a period of time, if the valuation gap too much diverge, eventually we have seen that there is some bit of re-rating or de-rating also happens in the space because the tailwinds, as far as sector is concerned, can't be restricted only to one or two companies. So eventually, maybe those are the pockets we look. But let's say market winners, as far as market share gains are concerned, I think if there are any mismatches available, or if you find that there are good product lineup for some one or two companies, but trading cheap, I think these are easier bet for us to go and trade.
All right. Well, with that, Sachin, time for us to wrap up this conversation. Thank you for sharing these insights.
Thank you. Thank you for inviting.
Thank you. And to our viewers, we hope you found this conversation useful. Do subscribe to our YouTube channel for more such interviews. Thank you for watching.